Welcome to our journey into the world of the stock market. Before we dive into the details, let's start with the basics. The stock market is a place where shares of publicly listed companies are bought and sold. It's a marketplace that connects buyers and sellers, allowing people to invest in businesses and potentially grow their wealth over time. Whether you're a beginner or have some experience, understanding how the stock market operates is essential for making informed financial decisions. In this video, we'll break down the key concepts, explain how trading works, and guide you through the fascinating mechanisms behind the scenes. Stock represents a share in the ownership of a company. When you buy a stock, you become a partial owner of that business. Companies issue stocks to raise money for growth, research, or expansion. Investors purchase these stocks hoping the company will do well, which could increase the value of their shares. Stocks are also known as equities, and owning them can entitle you to a portion of the company's profits, often paid out as dividends. Understanding what a stock is forms the foundation for grasping how the entire market functions. Companies often start as private entities, owned by a small group of people. When they want to raise significant funds, they may choose to go public by offering shares to the public through an initial public offering (IPO). This process allows them to access large amounts of capital, which can be used for expansion, research, or paying off debts. Going public also increases a company's visibility and credibility, but it comes with added responsibilities and regulation. Understanding why companies go public helps explain the flow of new stocks into the market. Stocks are bought and sold on stock exchanges, which are organized marketplaces like the New York Stock Exchange, NYSE, or NASDAQ. These exchanges provide a secure and regulated environment for trading. They ensure that transactions are fair and transparent, protecting both buyers and sellers. Each exchange has its own listing requirements, and only companies that meet these standards can have their stocks traded there. Understanding stock exchanges is key to knowing where and how trading happens. Trading stocks involves buyers and sellers coming together to exchange shares at agreed prices. This process can happen through traditional exchanges or electronically via online platforms. When you place an order to buy or sell a stock, your broker connects you to the market. Orders are matched based on price and time, ensuring efficient transactions. The ease of online trading has made the stock market more accessible than ever, allowing people from all walks of life to participate. Every stock trade requires both a buyer and a seller. Buyers believe the stock will go up in value, while sellers may think it's time to take profits or cut losses. The interaction between buyers and sellers sets the price of a stock. When there are more buyers than sellers, prices tend to rise. Conversely, if more people want to sell, prices may fall. This constant push and pull is what makes the stock market dynamic and ever-changing. Stock prices are always moving. They fluctuate based on supply and demand, company performance, economic news, and even global events. If investors are optimistic about a company's future, demand for its stock increases, pushing the price up. On the other hand, negative news or poor performance can cause prices to drop. This volatility is a normal part of the market and creates opportunities for both gains and losses. Brokers act as intermediaries between investors and the stock market. They help you buy and sell stocks, provide research, and sometimes offer advice. In the past, brokers were individuals you called to place trades, but today most trading happens online through brokerage platforms. These platforms make it easy to access the market, track your investments, and execute trades with just a few clicks. In trading stocks, you can place different types of orders. The most common are market orders and limit orders. A market order buys or sells a stock immediately at the best available price. A limit order lets you set a specific price at which you want to buy or sell. Understanding these order types helps you control your trades and manage risk more effectively. Stock market is made up of various participants, including individual investors, institutional investors like mutual funds and pension funds, and traders. Each group has different goals and strategies. While individuals may invest for long-term growth, institutions often trade in large volumes and can influence market trends. Understanding who participates in the market gives you a clearer picture of how prices are set and why they move. Many factors can move the stock market. Company earnings reports, economic indicators, interest rates, and political events all play a role. Even rumors or unexpected news can cause prices to swing. Investors constantly analyze this information to make decisions. The market reacts quickly to new data, which is why prices can change in an instant. You may have heard the terms bull market and bear market. A bull market is when prices are rising and investors are optimistic. A bear market is the opposite, with falling prices and widespread pessimism. These cycles are a natural part of the stock market and can last for months or even years. Recognizing the current market trend can help you make better investment decisions. Some companies share their profits with shareholders by paying dividends. Dividends are usually paid quarterly and can provide a steady income stream. Not all stocks pay dividends. Some companies reinvest profits to grow the business. For investors, dividends can be an important part of total returns, especially for those seeking regular income. Stocks are often categorized as growth or value stocks. Growth stocks belong to companies expected to grow faster than average, often reinvesting profits instead of paying dividends. Value stocks are considered undervalued compared to their fundamentals and may pay higher dividends. Each type has its own risks and rewards, and investors often balance both in their portfolios. Stock index measures the performance of a group of stocks, representing a particular market or sector. Examples include the S&P 500, Dow Jones, and Nasdaq Composite. Indices help investors track market trends and compare the performance of their investments. They are also used as benchmarks for mutual funds and ETFs. Market capitalization, or market cap, is the total value of a company's outstanding shares. It's calculated by multiplying the share price by the number of shares. Companies are often classified as large cap, mid cap, or small cap based on their market cap. This classification helps investors assess risk and potential growth. Investing in stocks involves risk, but it also offers the potential for reward. Stock prices can rise or fall, and there's always a chance of losing money. However, over the long term, stocks have historically provided higher returns than other investments like bonds or savings accounts. Understanding your risk tolerance is crucial before investing. Diversification means spreading your investments across different stocks, sectors, or asset classes. This strategy helps reduce risk because poor performance in one area can be offset by gains in another. Many investors use mutual funds or exchange-traded funds (ETFs) to achieve diversification easily. Successful investors often focus on the long term. By holding stocks for years, they can ride out short-term market fluctuations and benefit from compounding returns. Patience and discipline are key traits for long-term investing, helping you avoid emotional decisions during market ups and downs. Some investors prefer short-term trading, buying and selling stocks over days or weeks to profit from price movements. This approach requires careful analysis, quick decisions, and a higher tolerance for risk. While it can be profitable, short-term trading is not suitable for everyone and can lead to significant losses if not managed properly. Technical analysis involves studying charts and patterns to predict future stock prices. Traders use tools like moving averages, support and resistance levels, and volume indicators to make decisions. While technical analysis can help identify trends, it's not foolproof and should be used alongside other research. Fundamental analysis looks at a company's financial health, including earnings, revenue, assets, and management. Investors use this information to determine if a stock is undervalued or overvalued. This approach is often used for long-term investing and helps identify strong companies with growth potential. Market sentiment refers to the overall attitude of investors toward a particular stock or the market as a whole. Positive sentiment can drive prices up, while negative sentiment can lead to declines. Sentiment is influenced by news, economic data, and even social media trends. Understanding sentiment can help you anticipate market movements. Stock markets are regulated by government agencies to ensure fairness and transparency. In the United States, the Securities and Exchange Commission (SEC) oversees the market. Regulations protect investors from fraud and maintain confidence in the financial system. Understanding the role of regulation helps you appreciate the safeguards in place. An initial public offering, or IPO, is when a company offers its shares to the public for the first time. This event marks the transition from private to public ownership. IPOs can generate excitement and attract investors looking for early opportunities, but they also carry risks due to limited track records. After a company's IPO, its shares are traded on the secondary market. This is where most stock trading occurs. Investors buy and sell shares from each other, and prices are determined by supply and demand. The secondary market provides liquidity, allowing investors to easily enter or exit positions. Market makers are firms or individuals that provide liquidity by buying and selling stocks at quoted prices. They help ensure there are always buyers and sellers in the market, reducing price gaps and making trading smoother. Market makers play a crucial role in keeping the market efficient. Every stock has a bid price, what buyers are willing to pay, and an ask price, what sellers want to receive. The difference between these prices is called the spread. A narrow spread means high liquidity, while a wide spread can indicate lower trading activity. Understanding bid and ask prices helps you make better trading decisions. Volume refers to the number of shares traded during a specific period. High volume usually means more liquidity, making it easier to buy or sell stocks without affecting the price. Liquidity is important for efficient trading and helps keep transaction costs low. Stock trading doesn't always stop when the regular market closes. After-hours trading allows investors to buy and sell stocks outside normal hours, usually through electronic networks. Prices can be more volatile during these times due to lower volume, so it's important to be cautious. A stock split occurs when a company increases the number of its shares by dividing existing shares into multiple new ones. This makes the stock more affordable for investors without changing the company's overall value. Stock splits can attract new investors and increase liquidity. A reverse stock split is the opposite of a stock split. It reduces the number of shares outstanding by combining them, which increases the share price. Companies may do this to meet exchange listing requirements or improve their stock's image. However, the company's total value remains unchanged. Short selling is a strategy where investors borrow shares and sell them, hoping to buy them back at a lower price. If the price drops, they profit from the difference. Short selling is risky because losses can be unlimited if the stock price rises. It's a tool used mainly by experienced traders. Margin trading allows investors to borrow money from their broker to buy more stocks than they could with their own funds. While this can amplify gains, it also increases the risk of losses. If the value of the investment falls, the broker may require additional funds, known as a margin call. Exchange-traded funds, ETFs, and mutual funds allow investors to buy a basket of stocks in one transaction. These funds are managed by professionals and provide diversification, making them popular choices for beginners and experienced investors alike. ETFs trade like stocks, while mutual funds are bought and sold at the end of the trading day. Investors can earn money from stocks in two main ways: dividends and capital gains. Dividends are regular payments from company profits, while capital gains come from selling a stock at a higher price than you paid. Both contribute to your overall investment return. There are many myths about the stock market, such as the idea that it's just gambling or only for the wealthy. In reality, investing in stocks is about making informed decisions based on research and analysis. Anyone can participate, and with the right knowledge, you can build wealth over time. Emotions like fear and greed can influence investment decisions. Successful investors learn to manage their emotions and stick to their strategies, even during market volatility. Developing a disciplined approach helps you avoid impulsive decisions that can hurt your returns. Compounding is the process where your investment earnings generate their own earnings over time. By reinvesting dividends and holding stocks for the long term, you can benefit from exponential growth. The earlier you start investing, the more you can take advantage of compounding. Stock markets exist all over the world, from the United States to Europe, Asia, and beyond. Global markets are interconnected, and events in one country can affect markets elsewhere. Diversifying internationally can help reduce risk and open up new opportunities. Stock market crashes are sudden, sharp declines in prices, often triggered by economic crises, panic selling, or major news events. While crashes can be frightening, markets have historically recovered over time. Understanding the causes and effects of crashes can help you stay calm and focused during turbulent periods. Keeping up with market news, company reports, and economic data is essential for making smart investment decisions. Many investors use financial news websites, apps, and newsletters to stay informed. Regularly reviewing your portfolio and staying educated can help you adapt to changing market conditions. Many investors make mistakes like chasing hot stocks, ignoring diversification, or letting emotions drive decisions. Learning from these mistakes and developing a solid investment plan can improve your chances of success. Remember, patience and discipline are your best allies in the stock market. Building a strong portfolio involves choosing a mix of stocks, funds, and other assets that match your goals and risk tolerance. Regularly reviewing and adjusting your portfolio ensures it stays aligned with your financial objectives. A well-constructed portfolio can help you weather market ups and downs. Now that you understand how the stock market works, you're ready to take the first steps on your investment journey. Remember, knowledge is your most powerful tool. Start small, keep learning, and stay patient. With time and discipline, you can use the stock market to build wealth and achieve your financial goals.